Okay, as soon as it's recording. All right, welcome to the free weekend course. Yeah, my name is Zara. I've been trading forex for about what 5, 6 years now. Started back in 2015, and yeah, never looked back. Anyway, yeah, I'm gonna share a bit of things that helped me out when I was starting. Mainly this PDF. Yeah, it's just a combination of beginner stuff and a few advanced things. I think I posted this in multiple groups already. If I haven't and you want it, just simply just DM me and I'll send it to you. Anyway, yeah, covers technical analysis. So the first thing you need to know about is candlesticks. Let me first share my screen with you. Screen share. Hope you guys can see it. So yeah, here's a PDF, technical analysis, ZaraFx community. I use TradingView for my analysis, and for my software-based trade, I use MT4. Yeah. Anyway, now here's the first module. Oh no, first section, candlesticks. Candlesticks are graphical representations of market price movements within a specified time period. So we have different types of time periods like 15 minutes, 5 minutes, 1 minute, 30 minutes, 1 hour, 4 hour, right? So a candlestick is comprised of a few elements like the shadows. There's the top shadow, the bottom shadow, and there's the real body. So what the real body is the movement of price, like where it is it either bullish or bearish? So when something is bullish, it's when it's going up. When something is bearish, it's when it's going down. So as you can see this on the screen, this means that it's been bullish, right? So this represents on this time interval where price started, this is the opening. Usually if it's green, the bottom is the opening and the top is the close of that 15-minute period or 5-minute period, depending on the time interval you're on, of course. So this represents the candlestick movement. So basically, price could have went down, then up, then down, then decided to go all the way up and then retraced and closed right here. So this is basically the price movement on a 5-minute time frame for for whatever instrument you're looking at. And okay, bullish candles. Yeah, a bullish candle represents market prices that are moving up. As I said, the bottom is the opening, the top is the close. Vice versa for bearish. So yeah, the open would be the market price at the beginning of the time frame. So let's say if we're on 15 minute, could be 1:30, 1:15, or whatever's going on. You understand? So this was on a 1 hour time frame. So this could have been the opening maybe at 1, and this is the close at 2. This is the high. This is the low. The low is the lowest. Very good. Oh, sorry for that. Been a long day. Anyway, the open is where price opened. This is the low. This is the close. This is the high. Same thing for a bearish time frame. I mean, a bearish candlestick. A bearish candlestick represents market prices that are moving down. If you look back at whatever time frame you're looking at, 1 hour, 15 minutes, this is the open, this is the high, this is the close, this is the low. So the open is always higher than the close. Not sure if you guys get me. Is anyone in the waiting room? Let me check. Nope. Okay, that's cool. Okay, so trends. There's three types of trends really. There's an upwards trend, there's a downward trend, and there's a sideways trend. Upwards meaning it's going up, meaning price is making higher highs and the higher lows. Kind of like steps. Think of steps. As you go up, the steps get higher, right? And the floor gets higher, I guess. Again, yeah. And then a downtrend is when price is going down, where price is making lower highs and lower lows. And the sideways trend, it's making neither. Like it's moving sideways, meaning it's making the same highs and it's making the same lows all the time. So this is how an upward trend would look like. Higher highs, right? And higher lows. This is exactly how it would look like. An uptrend means that there are more buyers and sellers in the market at that moment. The buyers are pushing the price of that particular currency up. So trading is basically about supply and demand. Where there's more people doing something, that's where price will move to. You understand? When there's demand, price rises. When there's a high supply, price lowers, right? Kind of like a business. Think of you selling cars, right? If there's a high demand for your cars and the supply is little, what's gonna happen? The prices for the car is gonna rise, right? But if there's a high supply of that car and not a lot of people want to buy it, you're obviously gonna lower the price so people buy, right? Yeah. Here's a downtrend. Downtrend, price is making lower highs and lower lows, as you can see. Low high, low low, low high, low low, right? So in the downward trend, there are more sellers than buyers, meaning there's a high supply of price, and yeah, they need to bring it down so people can start buying, essentially. And here's a rich bond market. See, it's not making high highs, it's not making low lows. Really, you can literally trade these also. There's strategies to trade this. Anyway, there's something we use called support and resistance. So support and resistance is key levels in the market where where the forces of supply and demand meet. Meaning at that point, we've if there was a demand, if there's a demand, supply is met it. You understand? So basically, there comes a point in price where price is going up where okay, they meet sellers, or as price is going down, there they meet buyers. You understand? So we usually use uh areas where price was going down and when it got rejected, that level is usually support. Or if price was going up, when price got rejected, that price is gonna be called resistance. If there's an oversupply, price will go down. If there's a demand, price will go up, right? If supply if demand if demand and supply even out, price tends to move sideways in the range. Demand is synonymous with bulls, and supply is synonymous with sellers, bears. So support is the price where at which demand is thought to be strong enough to prevent the price from declining further. Meaning support is basically where there is enough buyers at that point where price doesn't go lower and yeah, there's enough buyers at that point where price starts going up. Yeah. As the price declines towards support, which means it gets cheaper, buyers become more inclined to buy and sellers become less inclined to sell. By the time the price reaches the support level, it is believed that demand will overcome supply and the price and prevent the price from falling below support. Here's an example. Support, 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 support. See, we have all these formations, W's and whatnot. Support, support, support. Yeah, and resistance, same thing. Well, just in the opposite direction. Resistance is the price level at which selling is thought to be strong enough to prevent the price from rising further. As the price advances towards resistance, sellers become more inclined to sell and buyers become less inclined to buy. By the time price reaches the resistance level, it is believed that supply will overcome demand and prevent the price from rising above support. So here's an example. Resistance, resistance, resistance again, resistance again, resistance again. So one thing you need to remember is supply, support and resistance levels are not exact numbers. Oftentimes you'll see a support and or resistance level that appears broken, but soon after you find the market was just testing it. Meaning It will sometimes go past that level and retrace back. Not sure. I'm sure most of you guys here have been trading for at least 3 months. You know exactly what I'm talking about. So yeah, fine. Now we're gonna talk about stops and targets. So stops are basically stop losses where you believe after price breaks here, or if it goes above this level, my setup is invalid. Or if it goes below this level, my setup is invalid. Depending, of course, if you want to buy or sell. And targets are take profits, basically where you believe, okay, price will get here. Once it gets here, I don't think it's gonna go further in my direction. Or okay, I'm satisfied here. Anyway, a stop loss order is an order used to exit a trade while at the same time limiting the eventual amount of loss. Some traders use them all the time as a regular exit strategy, whereas others will have emergency stops only to be used in the event something unpredictable happens. So we've seen in the past where there's been like flash crashes where all of a sudden in the AMs price shoots down like 5,000 pips. You know what I'm saying? Things like that happen, especially if you like holding trades overnight. Things like that will happen all the time. Yeah. Anyway, where to set a stop? Most people like using support and resistance based stops, meaning above resistance or below support. So these stops are usually set at the most recent swing high or low or a specific price that the market is bounced off repeatedly, either support and resistance. It is recommended to set the stop a couple of pips higher or lower than the area to allow for more safety. Meaning if you have a resistance area, for example, here, uh, above there, above there is where you set your stop. And be advised that this is not recommended in choppy or sideways markets. So take profits. A take profit is an order used to exit a trade with profit. They are represented by the number of points or pips a trader believes a currency pair will rise or fall, depending on his or her strategy and time frame. Calculations can be made using several tools, supported resisting heavily on time frames being traded. They are usually placed at previous support or resistance. Same thing, just on the winning side of the stuff. A higher time frame will allow the settings of wider targets, but this will also require wider stop loss. Here's a few classroom examples. You saw here, take profit above the high, and then your take profit would be here, previous support, you see, and yeah, that would be it, you'd be done. So yeah, for example, okay, here's a few examples. We have resistance, 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 right? And let's take you into sell. You'd sell maybe below once it breaks this low. Yeah, your stop loss would be above these highs. The take profit would be at this resistance. I mean support, right? So there's something called support turned into resistance or resistance turned into support. When does that happen? It usually happens when a support level gets broken. Usually when it gets broken, it will get retested, meaning price will come back to that level, tested, and if that level holds after it's been broken the support, we refer to that level as resistance now. You understand? For example, here we have a whole resistance, we have a whole support, got broken as you can see, came back for retest, and it went all the way down to the support level. And yeah. Anyway, there's also something called diagonal support and resistance. Most people refer to this as trend lines. It can either be an uptrend or downtrend. Here's an example. Here's a trend line right here, right? So if a trend line is needs to consist of 2 points. This could be the one high, this could be the other high, or this could be the one high, this could be the other high, right? And every touch after that is price testing that level as resistance. So your third touch, fourth touch, fifth touch, that's price testing that trend line as resistance. If it gets broken, usually most people wait for a retest and then take that, just so they make sure that that resistance level that was broken, diagonal one, is actually support now. Not sure if you guys get me, but yeah, that's it. And then we have things like different formations like double tops and double bottoms. These are very important, guys. If anything, take note of this. So double top is where price touches resistance, right? And then it retraces and it comes back and it tests it again. Usually when it tests it again, it usually goes higher. It usually goes higher than the first touch, and then price starts going down. So it kind of makes an M kind of formation. You can call it an M formation, double top, up to you. But yeah, that's what the pattern is. Usually these happen at resistance after the price has been going up for some time, like major resistance. You can usually spot these on lower time frames. They work best on like 30 minutes, 15 minutes for like one of those precise entries. Also, you have to take into consideration candlestick formations, but yeah, I'll show you those just now. So a double top is a versatile pattern that can be seen in all time frames. It often forms when price has moved up for an extended amount of time. The tops are formed when price hits a certain resistance level where it cannot break it to the upside. When price does not break this resistance level above top 2, this is a strong indication that a reversal is going to occur. So here's the first peak, touches support, which we call the neckline, and then there's the second peak. And around here, you'll usually see some candlestick formations or whatever's happening. And then price decides to break out and go all the way down. Different people take these trades differently. Some people take it here, some people take it here. Different confirmations for different people. And we have a double top. A double top is the exact opposite of a double bottom. It's when price has been going down for an extended amount of time, and then it cannot break that area, and then retest it again. And then at that point where it retests it and it fails, that's where we consider it to be a double bottom. Here's an example of one right here. A double bottom is the opposite of a double top. Yeah, hope you get it. And then we have things like triangles. Triangles are basically where price is, it's getting, what can I say? It's getting compressed. It's making higher highs, right? I mean, it's making lower highs and it's also making higher highs at the same time. So price gets compressed to a certain point where it decides to break out either to the top or to the bottom. For example, here's an example: making lower lows, lower highs, and making higher lows, and it breaks out, and yeah. And then we have things like what's this shit called again? What are you called again? Oh, bullish triangles. So bullish triangles happen when price is not forming higher highs or lower highs. It's just hitting resistance, but at the same time, price is forming higher lows. So as it forms higher lows, it kind of tells you which direction it's gonna go because it keeps on getting higher and higher and higher and higher, but it also keeps on getting compressed, and then it eventually breaks out, and yeah, that would basically be a trade where it breaks out. Kind of looks like this. These happen all the time in the market. And then we have bearish triangles, the exact opposite of what I just spoke about. The price is making lower highs, and the lows are just not going high or low. Yeah, think of triangles. Just know that the other one is bearish, the other one is bullish. Yeah, and it breaks out, and then price continues to go down. So here's how a a bullish triangle would look like. Support levels are rising, uptrend, resistance levels. Resistance reading is just testing, testing, testing. It's not going higher or lower. And then as it goes higher, you should eventually breaks out, sometimes retest, and then you take the retest. Because remember, support tend to resistance, resistance tend to support. So in this case, resistance was broken, and then we obviously expect price to turn that resistance level into support, right? Yeah. And then we have things like heads and shoulders pattern. So heads and shoulders patterns are usually when price is making higher highs, right? It's an uptrend, and then price decides to break that uptrend, right? Maybe we have like a trend line or whatever, decides to break that uptrend, and then price tries to go up again, but fails to break the previous high. That's what would be a heads and shoulders pattern. Or in a downtrend, an inverse head and shoulders pattern is when price is going down. It's making lower highs and lower lows. But then all of a sudden price decides to go up. When it decides to test the second high, when it decides to test the low again, it doesn't it doesn't it doesn't break the previous high. It's usually around the same level as the second previous low or the second previous high. Something like this. We have uptrend, higher highs, higher lows. As you can see, price failed to break, or we could say price broke this trend line, and then when it broke it, price decided to go up again and failed to break this high. And then there was a neckline formed. Here are the shoulders, one, two, and then price broke out, and then it usually comes and reaches the neckline and continues to go down. Hope you guys get it. Heads and shoulders pattern usually form from an uptrend, indicating a reversal. It can also be a continuous pattern for a downtrend. It's a bearish indication, so when you see this pattern, you know price is going to drop. The lows are formed at the support of the shoulder. Uh, the lows are formed at the support of the shoulders and at the head. Uh, the neckline is created. When your neckline has been broken, you calculate the pips from the top of the head to the neckline to determine how many pips the breakout will be. So kind of like this. You calculate the number of pips from here to here, and then you'd extend that all the way down. Up to you, really. Same thing for an inverse pattern. So we have a downtrend, and then price from this neckline, and then price from the head. The head is usually like a lower low, and then prices as come up, it will usually form a higher high. Those ones are usually the best ones. Where price forms a higher high compared to the previous low, and then once it goes down, it forms a higher low, and then through that you kind of know what kind of formation it is. Hope you guys get it. Yeah, well, these they hardly happen. Skip those. They hardly happen. So I'm going to talk about continuation patterns now. We have flags and we have pennants. So what a flag is, it's usually when price is going up on an uptrend, and then it's got a brief consolidation, usually a bit tilted, right? It forms a flag kind of formation, something like this, and then it later breaks out and goes and continues in the same direction as it was going. So usually a steep ascent, meaning a very deep bullish pattern. That's steep ascent. Then a consolidation, then a breakout, and it continues. The flag and the pennant are treated the same because they show up in similar situations and they are both continuation patterns. They appear after a market ascends or descends with momentum, forming a series of long candles or a pole-like structure. After the pole, market consolidates and forms either a flag or pennant. Yeah, whatever. After the steep move from the market consolidates with parallel lines forming a flag before it breaks out in the same direction of the steep move. So kind of like this. Here's a pennant. Steep descent, long candles, full kind of like movement, consolidation, and then we have our pennant drawn, and then we have a breakout and it continues. Yeah, something like that. And then we have things like Fibonacci. Fibonacci is basically uh, percentages in which price would retrace before it continues going in that direction of the trend. So we have high highs, high lows. You usually pull it from the top, from the bottom up. If you are in an uptrend and price is is retracing. Or if you're in a downtrend, you pull it from the top to the bottom, and then you catch the retracement. The strongest ones are usually 50% and 61.8. So once price retraces around 61.8% of the trend, you could expect uh, um, a retracement around that level. I think I explained it all. Really. Yeah, to plot. Yeah, well, I explained this. Well, yeah, I think I explained it all. Really. Yeah, that's just the PDF. Yeah, I'm going to show you guys how I go to put in resistance now. And then yeah, I really did it. I really did it, by the way. I usually use TradingView. So if you have a question, you can type it and I'll try my best to answer it. I'll try my best to answer it. I'm gonna post this webinar on YouTube just now, and I'll send you guys the link. If you guys have any questions, I'm more than willing to answer them. Any questions? Okay, it doesn't seem like there's any. So yeah, I'm gonna end the meeting now. If you have any questions, you can always DM me on Instagram. My Instagram is ZaraFx. That's my business page. Or you can DM me on Telegram. Most of you have my username on Telegram. My username is @ZaraFX1. DM me there. You can ask me some questions. I'm gonna run the promo now till midnight. No, till tomorrow midnight. Again, for those interested. And yeah, okay, wait. I think there's a question. Chat. Thank you, Divine. Thank you for your time. Blessings, blessings, blessings. Hope you guys learned something. And yeah, man, let's kill it. All right, I'm gonna end the meeting now. Have a great day, guys.